good afternoon, everyone, and thank you for joining us for this overview of the Ellerston Asia Growth Strategy. My name is Lisa Rose, and I'm the Head of Intermediary Sales here at Ellerston Capital. We're delighted to have you all attending as members of the Ethical Advisor Co-op. And by way of introduction, I'm also joined by the Portfolio Manager for the strategy, Dr. Mary Manning. We also have a number of members of Ellerston's national distribution team also dialed into the call, including Irene Cardassis, Nathan Burrows, Eric Candido, and Andrew Coolman. I'm shortly going to hand over to Mary, who will provide an overview of the Ellerston Asia Growth Fund, discuss integration of ESG factors within our investment process, and detail recent performance outcomes for the fund. Given we have a number of you on the call, we'd politely ask that questions wait until the end of the session. However, you can submit them via written form at any time throughout the presentation by using the Q&A section on your webinar panel located on the right-hand side. I'll now hand over to Mary to start the presentation.
Great, thank you very much, Lisa, and thank you to all of you for joining today and for the opportunity to speak to you about the Ellerston Asia Fund. So before we get into the Asia Fund, I'll just talk a little bit about Ellerston Capital and our commitment to ESG and responsible investing. Ellerston is a boutique Australian fund manager that was started in 2014. We are aligned with our investors. 75% of the firm is owned by staff. We've been recognized as a leading responsible investor by RIA. Ellerston Capital is a signatory to the Principles of Responsible Investing, and we're also a signatory to Climate Action 100. So it's not just my fund. Ellerston as a firm is very committed to ethical investing and to responsible investing. So if we go over to slide 4, I will start by introducing myself and the team. So I'm the portfolio manager of the Asia Fund, and I've been investing in Asia since 1996. I actually first went to Asia during the Asian crisis, which was a fascinating time, but most of my career has been spent investing in emerging markets and specifically in Asia. I have a PhD in economics and an MBA from Harvard Business School. Supporting me on the Asia team is Freddie Ho, who's the Deputy Portfolio Manager, Eric Fong, and Vinay Chota, who are analysts. That's another important thing to highlight is that at a firm level, we are very supported in Asia. Ashok Jacob is our chairman. He's originally from India and has over 30 years of investment experience, a lot of that also in Asia. And then we do have James Taylor, who is the firm-wide head of ESG, who is someone that we use quite regularly to bounce ideas off of and to make sure that our decisions with respect to ESG and responsible investing are in line with protocols. So moving forward, this is just an introduction into the Ellerston Asia Growth Fund and what makes this fund special and differentiated from its peers. The first is, as the name suggests, this is a growth fund. So, I do have a PhD in economics, and I spent a lot of time looking at macro research. And I think that Asia is the best, hands down, the best growth story in the world right now, particularly after COVID. That point has been reinforced by how economies are looking in a post-COVID world. So if you agree that Asia is the best growth story in the world, it seems strange to us to invest in Asia in anything other than growth stocks. Why would you go to the best growth region in the world for value or for dividend yield? So Asia is a growth region, therefore we only invest in high growth stocks. I think you'll see later on some of the slides that our process is geared around identifying what the best growth stocks are in Asia. Secondly, Ellerston Asia is a concentrated fund. I can only have between 20 and 50 stocks. I think the average over the life of the fund is about 34. Right now I have 46, which is a bit higher, but nevertheless, there are thousands of listed stocks. There's over 1,200 stocks in our benchmark, and we pick, the best 34, the best 46 to have in the portfolio at any given time. This is not just a scattergun approach, having lots of stocks in the portfolio and then charging people a management fee for that. It's very curated. The third thing is strong ESG and commitment to responsible investing, which is what the remainder of the presentation is primarily about. The fourth thing is high quality. So we do not invest in low quality companies we need to have met with or, in a COVID world, at least spoken to on the phone, all the management teams. Before we invest in a company, the average ROE is very high. So this is a high quality fund. We do have a large cap bias. The average market cap of the Asia Fund is over 150 billion. And, some people were sort of surprised at that. They thought, I didn't even know there were really any stocks besides Tencent and Alibaba that were bigger than 150 billion. And the average of our whole portfolio is greater than that. So we very much have a large cap bias. And part of that is related to ESG and responsible investing. Because a lot of the back testing that we did early on showed that as you go down the market cap curve, certainly your governance gets worse. E and S, may stay the same, but governance, there's a very strong correlation in Asia between smaller companies and and worse governance. Also, we looked at performance, and over time, the MSCI Asia ex-Japan index, the large cap index, has outperformed small and mids quite significantly. So if you look at it from that perspective, large caps are a better return for lower risk, and that's why we have a large cap bias. And then lastly, we have a dedicated Asia team. As you saw on the slide before, it's myself supported by Asian analysts, and we have extensive language capabilities. Both Freddie and Eric speak Mandarin. Eric also speaks Cantonese, and Vinay speaks 4 different Indian languages. So we are a dedicated Asia team, and Asia is all that we do. That's a big differentiating factor compared to some of our peers, where they're a subset of the global team, or they look sometimes at Asia and sometimes at other markets, or they do Asia, but they mostly focus on Japan, and that is not our team at all. All we do is Asia ex Japan all day, every day. So that's just an introduction to the key characteristics. Now we'll flip over a few slides, and I'll talk to you in detail through our ESG process. So before I start, I'll just highlight some of the reasons why we, from the very beginning of this fund and the predecessor to this fund, had a strong focus on ESG. One reason is because I think it's the right thing to do. That's a personal preference of mine. But regardless of what your preference or other of our investors' preference is, if you run a concentrated fund, you cannot afford to have any ESG, particularly ES or G, mistakes in your portfolio. Because say we only have 20 stocks in a portfolio, we also have a concentrated top 10. Some of our portfolio sizes are like 10, 12%. If you have an ESG issue with one of those companies and it gets delisted or it goes down 40% in one day, in a concentrated portfolio, your performance will be absolutely shot. Potentially, it will take you years to dig yourself out of that kind of hole. So ESG is partially because I think it's the right thing to do, and secondly, because it's a risk mitigation tool. And we've seen it many, many times in Asia, whether it's environmental issues with plants or social issues with labor forces, or like many, many times governance issues. ESG is an important way to manage risk in Asia. I think the second thing I'll say before I go through the process is that Asia gets a bad rap in terms of ESG, and I think it's largely at this time in history unwarranted. As I mentioned at the beginning, I first started working in Asia during 1996 during the Asian crisis, and governance and ESG in Asia at that time was pretty bad, I will admit. But in the last few decades, things have improved very considerably. And I think that sometimes there's a misperception, certainly among Australian investors, that there's lots of governance problems and you can't trust the numbers and all this stuff, which is really a decade plus old. And I'll tell you an anecdote which sort of highlights this. During the Royal Commission, I was actually on a trip in Asia, and I went to see some banks. And this one guy was telling me, I can't believe this, because investors from Australia, from some of the banks that are now on trial, essentially, they come to me and they're saying, well, what are your ESG credentials, and are you sure this is happening? And really, it's the pot calling the kettle black, because the ESG at some of the Australian banks is actually much worse than what we're doing, at our own institutions. So I guess I'm sure aware of that, but I think that ESG in Asia has improved a lot, and it's certainly much better than people think. So moving on to our process. We have this 5-step process because, for one, I'm a very process-oriented person, and our entire investment process is very, very step-oriented, and it's easy to follow. So if a new analyst comes onto the team, everybody can figure it out. The first thing is ESG screening. So there's thousands of companies in Asia. How do we, get rid of the very bad ones? So the first ESG screens are all done automatically. We don't go through all thousands of stocks and give them an ESG score. And they're knock-ins and knockouts. So in terms of these screens, we have a score of 0, which is neutral, -1, which is a knockout, and +1, which is a knock-in. And it's sort of a barbell approach. So about 80% of stocks at this first screening level get a score of 0, and then there's the barbell. There's about 10% on either side, more in the negative. But this just goes through and gets rid of stocks that there's something that's very, very clearly wrong. The next thing is ESG scoring. So for this area, we have an ESG matrix, which looks at materiality and then a performance score. So the reason we think it's important to highlight materiality is, if a bank has an environmental issue, maybe there's something wrong with the light bulbs, or I don't know, it's generally not as material to their to their operations and to their financials as it would be for, say, a commodity company or a resource company. And so we rate their score on E, S, and G, and we also rate their materiality. And then that, this is for companies that have made it through the scoring and the screening processes and the other scoring and screening processes that we have at a fundamental level. So there's only about 100 stocks here that we're doing the ESG scoring. So we do a full matrix, and they come out with a very detailed score, again, of 0, which is neutral, -1, which is a knockout, and +1, which is a knock-in. Then there's ESG integration. So as I'm sure you're aware, ESG has become very popular, and a lot of funds just have some ESG process that they tack on the side, and they hope they can tick the box of doing ESG. Ours is not that at all. In the very first presentation that I took to Ashok Jacob, our chairman, to launch the Asia Fund, we had ESG integration in that first presentation. What ESG integration means is that all the stocks that get into our fund have a score, and they have to have a score of above 5. We can go on later, how they get to that score. And what happens is those scores that I've discussed in the first two boxes, the 0, -1, or +1. If it's a -1, that gets integrated into the fundamental analysis, and those stocks will then are not eligible to enter the portfolio, even if all the other fundamental analysis that we may have done or may be looking to do points to a positive investment thesis. If they have a -1 score on ESG, they're not eligible to enter the portfolio. So that integration is very consistent, and it's also very strict. I know there's other methodologies out there where if you have a stock with bad ESG, you just increase your discount rate on your DCF, or you do something to the valuation. That is not what we're doing. We do not want bad stocks in the portfolio, full stop. So that's why we have a knock-in, knock-out system. The fourth thing is ESG measurement. And this has actually been the biggest improvement in our ESG process, I'd say, over the last 2 to 3 years. So when this fund started, those first 3 steps were always in place. And we knew sort of deep down in our hearts that this was a good ESG process because we could see stocks blowing up and we didn't own them. But it was very hard to measure the effectiveness of our ESG process in terms of managing risk and managing ESG outcomes. And then a few years ago, we started subscribing to Sustainalytics, and this really enhanced the ESG measurement part of the process. So what we do is at least every half year, generally every quarter, we go to Sustainalytics and we run our portfolio versus our benchmark, and then we look at ESG risk outcomes. And you'll see some slides later on that our ESG risk is lower than our benchmark. That's what we're aiming for. And then lastly is ESG engagement, which is something we take very seriously, and I'll get to that in some of the next slides. So if we move on, I think there's just a bit more detail on what I've talked about. Okay, so the ESG screening, this is the very first box that I was discussing. We do screen out certain sectors, and some have a 0% revenue threshold. Those are significant harm sectors, such as tobacco production, weapons, and weapons. Those are the 2 main ones. And then we have others that have a 5% revenue threshold that are typical sectors that would get screened out. So that's the first at a sector level ESG screening. If you go on to the next slide, this is a proprietary stock screen. And in that very first box, how I was saying stocks can either get a 0, -1, or +1. This is we've made it into a slide, but really this is like thousands and thousands of cells in Excel that go through environmental criteria, social criteria, and governance criteria. And if a company gets too many negative scores or just does not have the proper disclosure, or you can read the details there for yourselves, then they get a -1 in that very first screening stage, and they are not eligible to go any further in the portfolio. If you go on to the next one, this is the ESG scoring matrix that I was talking about. You can see here it's for ICICI Bank, and this company is getting rated on E, S, and G on performance and materiality. This comes out as a score for 0, and this is what gets integrated into the next slide, which is on slide 11. So in terms of the integration, this last, the box with the circle around it is ESG. Even if a company, jumps over all those other hurdles to get into the portfolio, so they have to have high growth, they have to have at least 50% upside over 3 years, they have to have a strong industry structure, and typically meet one of our 4 thematics, related like management. If all that is in place, but they have a -1 score in ESG, and we found ESG issues, they get kicked out and are not eligible. The other thing I'll highlight is, we needed to do it in a step function for diagrammatic purposes. But ESG is not the last thing we do. It's not like a tack on, but it is in a way the most important thing that we do. And so, the analysis gets done. And as I mentioned before, even if it is, if we really like the stock, but their ESG is not acceptable, then that stock will not be considered for the portfolio. Moving on to the measurement, this is the outcome of the Sustainalytics process that we ran recently. So Sustainalytics rates ESG risk severe, high, medium, or low, and our goal is to have less severe risk than our benchmark, and we typically want that number to be 0. So you can see the last time we ran it, we did have 0 severe risks, and that's great. We also would like to have less high ESG risk in the portfolio than the benchmark, and that is also the case. And I'd like to highlight that these charts look like this the very first time we ran it. We got our Sustainalytics login, and I uploaded the portfolios, pressed the little button, and it spits out this whole report for you, and this is what it looked like. So that was very great for me because, as I mentioned before, we thought that this was a really good process, and the very first time that we ever measured it, it did highlight the fact that the process is effective. Then mathematically, you can tell that if we have lower severe and lower high, then we must have more medium and low risk than the benchmark, and that is indeed the case. We also look at management's, how management deals with ESG risk. That's the part on the right-hand side. We spend a lot of time with management teams, and how management deals with ESG risks is an important part of our process. So generally what we're looking for in these results is that we have lower exposure to weak management teams or management that deal in a weak way with ESG. And then, again, mathematically, we should have higher exposure to average and strong. Again, first time we ran this is how it came out. So there was strong justification that our process is effective. Moving on to the second part of measurement, this is carbon risk. So again, Sustainalytics is very helpful in allowing us to very easily check on the environmental impact of our portfolio. So we want lower, high, and severe risk than our benchmark, and you can see that that's certainly true. We have one stock, Reliance in India, which is rated severe, but it's that's sort of a legacy rating. It is an energy company, but it's now become a conglomerate, and energy is actually a very small part. Nevertheless, it's still rated as severe by Sustainalytics. But we have much less exposure to high and severe, and then higher exposure to low and negligible risk from a carbon perspective, overall carbon risk rating. And then carbon intensity. The fund, because we're oriented towards growth stocks, we generally tend to have 3 core sectors, which are technology, financials, and consumer. And so straight away, just because of our sector allocation, we tend to have a much lower carbon intensity than an average portfolio, certainly than the benchmark. But again, first time we ran it, you can see that our carbon intensity is significantly lower than what you would get in the overall benchmark. So that's just an overview of the ESG process, and I'm looking forward to getting some questions in the Q&A if you have any on that. So if we move forward to the next section, these are just some worked examples to sort of bring to light what, how this actually works in practice. So the first one is very easy. We screen out tobacco, and so Sampoerna is an Indonesian cigarette company, and so right at the get-go it gets screened out, and we don't do any more work on it. So that's an easy one, but just to show you that that's sort of how the screening out works. The second one is a negative scoring example. So this is Celltrion in Korea. So when Celltrion goes through our spreadsheets, it's high growth, it has upside, et cetera, but it does have ESG issues. So when we do that matrix, it got a -1 score, and then it was no longer eligible to be analyzed or to be included in the portfolio. The next one is a positive scoring example, and this is TSMC in Taiwan. We actually have very few +1s. It's something that we are very actively working on, and you'll see in some slides later on, particularly with China Net Zero, we're anticipating have a lot more +1s in the portfolio going forward. But TSMC is the world's largest semiconductor foundry in the world. It's a leader in terms of a lot of manufacturing processes, and it's also a leader in applying these in an environmentally friendly way. So this is an example of a company that gets a +1 score. In terms of engagement, engagement is very, very important because we are long-term holders of these stocks. I'd say of our portfolio now, at least a third we've held since inception. And some of these stocks like DBS and ICI, I've held them in previous roles, and I've known some of these management teams for 20 plus years. So engagement is very important. And if there's an issue that is not a screen out issue, it's not major, but it's something where we would like improvement. Disclosure is probably the best example here. having those relationships with management and having an ongoing dialogue about ESG issues is very helpful. So Reliance was the company that I mentioned in India, where it's probably the company where we've had the most level of engagement on ESG, partially because it does have that energy business, and that's something that we are constantly watching. The company has also said that they're likely going to split the company up. So energy is going to be one part of the business, retail is going to be another, and then telecom. So we are constantly encouraging them to get on with those IPOs so that we can just be invested in the telecom and retail businesses, which are the ones that we like and that are better from an environmental perspective. In the last 3 years, we had multiple meetings with Reliance on the ground in India, and since we've been, stuck here with respect to COVID, we've had almost quarterly calls and video conferences with them. So consistent engagement. We voted at all the AGMs, and interestingly, from an ESG perspective on governance, is now a lot of AGMs are virtual, and so we've gone to a lot more AGMs this year than we would have in the past when they've been on the ground in the countries in which we invest. CA 100 is something that I mentioned at the beginning that Ellerston Capital is part of. So this is a number of funds that get together on certain stocks, and if you have a common view or if you have common requests from the company, if many funds go to the company together and ask for this, you have a better chance of getting a positive outcome than if you just go on your own. So I had dialogue with CI 100 about Reliance, particularly in terms of improving disclosure. So that's something that we're working on. And yeah, you can see some other things with the AGM and other calls we've had, whether it's the dividend policy, executive pay, or board diversity that we have engaged with respect to Reliance. And then the last one, you may be asking, okay, well, what happens if a company is good and then something goes wrong? Does it get kicked out of the portfolio, or how do you deal with changes with respect to ESG over time? So the answer is that every single Monday morning, we run all the stocks in our universe through that sort of hurdle diagram. It's all in Excel. This is just for diagrammatic purposes. And if there are any changes and a company has moved from a neutral to a -1 rating and it's in the portfolio, then it will be removed immediately. So we did have an example of this. It's probably about 2 years ago now with JD.com, where the CEO got into trouble in the US and there were potential criminal charges. And so we moved it to -1. It was out of the portfolio. And then months later, when the charges were dropped and he was cleared, then it can go back into the portfolio. There are similar things. Samsung is another example. This is a good example because Samsung is a very big part of our benchmark. And you may remember a few years ago when Samsung, their Note product was blowing up. And, you get onto an airplane and it'd say, if you have the Samsung product, get off now. And it was, Samsung was our second largest position at the time. And I made the view that it's not acceptable to invest in a company that's products are blowing up and harming people. And so we got out of the entire position. And then Samsung came out and they did the recall and they figured out what had gone wrong and they addressed all these issues. So then we got back into the stock. So it's not, once you get a -1, you're not in the doghouse forever. But we are constantly monitoring those +1, -1, and 0 scores to make sure that it's accurately reflected what's going on at the current time. So that's an example of engagement, divestment, and then reinvestment. Lastly, I'd just like to talk a little bit about a new thematic that we have done a lot of work on probably in the last 2 months. And I think going forward, I'm expecting me and the whole rest of the team to be really focused on the thematic. And this is China net zero. So as many of you may know, China came out at the end of last year, the fourth quarter of last year, and said they want to have net zero emissions by 2060. And that is a very, very aggressive time frame considering where China is in its economic development cycle. So a lot of the economists and the bureaucrats in China worked backwards, and they said, okay, if we're going to be at carbon neutral by 2060, then there has to be peak emissions by 2030, which is only 9 years away. And when you have an economy as big as China's, that's growing as fast as China's, and there's certainly not Beijing and Shanghai, but a lot of other areas of China which are still in that very early stage of industrialization, you're going to have to make major changes to your energy mix in order to get to peak emissions by 2030. So we have a list that's much longer than this. I think at the current time it has about 34 different companies on it. But we broke it down to 3 buckets where we want to start looking for beneficiaries of China net zero. One is in renewable energy, because they're going to have to move very strongly to alternative energy sources. So Longi and Jinyi Solar, those 2 logos there are both solar. So that's something, we actually own both of those already, and that's an area where we're doing more work. Electric vehicles, this is something that's important around the whole world, as I'm sure the people on this call know. So electric vehicles, we own NIO, which is the Tesla of China, and that has been a very high-performing stock. The valuation is actually quite rich now, so we're not buying more, but that's been a very strong performer. And we own Geely, which is it's a OEM, but they have a very burgeoning EV business. There's also XPeng, Xiaopeng, and Li Auto, which are also electric vehicle companies in China. And we expect these. NIO is already over 100 billion market cap, and lots of people have never heard of it. So it's a very big company, and it's China's Tesla. And then I guess the third part, which this little tiny thing on the right-hand side of this page doesn't do it justice, is the supply chain. So one of the big pieces of intellectual work that me and my team are looking at is, say 15 years ago when I was investing in Asia, the Apple supply chain was a huge thing. It drove the economy, particularly in Taiwan and in large parts of China, because you had this boom in smartphones, and then all the stuff that goes into smartphones had to come from somewhere, and it was largely from Korea, Taiwan, and China. So the EV supply chain is looking like it's going to be very, very similar. Tesla, obviously is very tied to Shanghai. NIO and Xiaopeng and Li Auto are Chinese EV companies, so they want their whole supply chain in China. And a lot of the biggest battery makers, actually all the biggest battery makers are in Asia. You have 2 in Korea and CATL, which is in China. So that whole supply chain, we think over the next 10 years is going to throw up a lot of very, very interesting investment opportunities. And we currently own all the stocks on that slide under the green supply chain except for CATL. So it's a very interesting and exciting thematic. And these stocks, they would score a +1 on E, and then as long as they score zeros on the E and the S, they would end up as a +1 in our overall, in the overall score. But it is important to highlight that just because you're a green company doesn't mean you're automatically a +1 on ESG. If you are a green company and you meet the environmental credentials, but you have terrible governance or you treat your employees badly and your plants are collapsing and harming people, you will not get a +1. It doesn't matter what you do. These companies have a much higher chance of getting a +1 than, say, companies that don't have the sort of green angle. Okay, so moving forward to the next section of the presentation, I'll talk a little bit about performance and then just a little bit about what's happening in Asia now and why we think that this is a fascinating time and a really exciting time to be looking at Asia for investment. So this is performance over the last, the different time frames. Over the last year, the portfolio was up 12%. So given everything that happened with COVID and COVID volatility and the fact that it started in China like almost exactly a year ago right now, we are pleased to have absolute returns of around 12%. You'll note that that is much higher than what investors would have received in Australia and higher than what you would have received in a lot of different global funds. So the asset allocation decision that our investors made to go to Asia was the right one, and we hope that can continue going forward. We also did outperform the benchmark in the last year by about 60 basis points. And you can see 2 years per annum, 3 years per annum, and since inception, we've also outperformed the benchmark. That's a little bit about performance. I'll just move on to the portfolio allocation and give you just a few quick bullet points about how I'm looking at Asia right now. I guess the first thing is that Asia did a much better job of managing COVID than the rest of the world. Even though it started in China, a lot of Asian countries went into lockdown early on, because of SARS and MERS. This was our analysis. Largely because of SARS and MERS, Asian countries were much more prepared to deal with this sort of epidemic or pandemic. And with a few exceptions in ASEAN and perhaps India, Asia in general did a much better job of managing COVID. So the benefit of that is that the growth is much better than you're getting in developed markets like the US or certainly the UK. So for a growth fund, that's very favorable for us because the GDP growth is still there, and that means that a lot of the companies are still getting the growth that meet our high growth criteria. I guess the second thing that's important is a weak US dollar. Since President Biden has come in, and certainly before that, the US dollar was weakening, and that is a positive for flows into emerging markets, and Asia is about 80% of emerging markets benchmarks now. If you do some adjustments for some stocks, it's by far the majority. So a weak US dollar is good for EM, and we've seen that playing through. The third thing is that we are now in a post-Trump world, and as a portfolio manager who has been dealing day in, day out with Trump's tweets for 4 years, let me tell you that is a fantastic, it's a wonderful change. And we don't think that, Biden's certainly not going to be soft on China, and he's not a China dove, and the appointments that he's made in key positions thus far do not indicate that he's going to be soft on China. But we do expect for it to be a more multilateral approach towards China. So, Biden will get friends in Europe and Canada and Australia and elsewhere in the world to engage with China as a group rather than sort of one-off tweets or, meetings between Xi and Trump. And that will be helpful from understanding and being able to anticipate policy changes. Whereas the problem with Trump is that you just couldn't anticipate anything. You woke up in the morning and there was a tweet and things were totally different. So I think in terms of, we have about 45, is a little bit higher than what that says now, say 50% of the portfolio in China. Having a post-Trump world is very favorable in that respect. And we do not expect the sort of trade war and the capital market war that was going on before to continue the way it was under President Trump. I think the last thing I'll say about why Asia is really exciting right now is the IPO pipeline. So there are some very, very high-profile IPOs. And when I say the IPO pipeline, I don't mean like $2 billion here and $3 billion there. I mean like $200 billion plus companies that are IPOing at that level. We have one, Kuaishou, which is going to list later on this week. And it's in the gray market, it's already up 200%. So that'll make it like almost a $200 billion, a little bit less than $200 billion market cap company just on day one. So these are mega cap IPOs. They're almost all tech or tech related. They're fascinating companies, and you can't get exposure to that via your PA. You need to get it via a fund. It's even hard to get exposure to some of these as a fund. But we think that the IPO pipeline is really exciting. So given all that, how I'm positioned right now, we do think that post-COVID Hong Kong, China has some of the best growth opportunities out there, and we really like the Chinese tech companies, and as I mentioned before, the Chinese EV companies. So we have about 50% of the portfolio in Hong Kong, China. Korea and Taiwan are primarily tech exposures. We have very few, sector exposures outside of technology in Korea and Taiwan, but they are tech powerhouses, and we expect to continue to be allocated that way. India is a country that Ellerston really likes in the long term. We actually have a separate India fund because we see so many opportunities in India. For those of you that follow markets very closely, India had its budget yesterday, and it was a blowout fiscal spend. I mean, like way higher than anyone was anticipating. The Sensex was up 4.5% yesterday. We had over a third of the portfolio was up 10% or more. So India, now we can talk later about whether that's the best thing to do from a long-term fiscal perspective, but for right now, they are just trying to knock it out of the park in terms of resumption pre-COVID growth. So India is also a very exciting country. And then ASEAN, we generally have less exposure to because our three core sectors are technology, financial, and consumer, and there aren't that many technology companies in ASEAN. We primarily end up owning a lot of the financials there, but that doesn't add up to a big weight. In terms of sector allocation, financials, tech, and consumer are definitely the three most dominant sectors, and that has been that way in the past, and we expect that to be that way in the future. From a responsible or ethical investing perspective, we don't tend to own many materials. I think right now we have one cement company. We don't tend to own many materials or a lot of the sorts of companies that create ESG risks in an Australian portfolio. Those companies don't meet our growth criteria, and they are generally not part of our portfolio. You can see that very clearly in the top 10 holdings. The top 4 are all tech, and most of the rest of the 6 are financials or in some way financial. We are concentrated, as I mentioned before. So, if I want to have 10% of the portfolio in Samsung, which is roughly where I am now, then, I don't have to stick to what the benchmark is saying. On the other hand, if I don't want to have any Samsung, as I mentioned before with respect to the note issue, then I can have none. At certain times we've had, our large position size has been 14-15% of the fund, and we are concentrated and proud of it. So I like to have, if we're going to do all the work and have really strong conviction about a stock, then that's going to be reflected in the position size. So I think that's it for the formal presentation. I hope you've learned a bit about Ellerston Asia and certainly about our ESG and responsible investment process. I think with that, we'll open it up to Q&A.
Thank you, Mary. We've got a couple of questions that have come through as Mary's been presenting, but please, participants, do feel free to send questions directly through to us via the Q&A section of the webinar panel. Mary, we've got a question here. What input, if any, does your head of ESG have over the portfolio?
Yeah, okay, so we are really thrilled to have James on board. And this ESG process was in place before James got here. So me and my team are all very comfortable with it. And, there haven't been major changes. Where James, I really appreciate his input, is on a lot of the bigger picture issues where he is very, very well versed and extremely educated. So that that's his day job, right? Whereas our day job, we are constantly picking stocks and looking at 1,000 things, and it's nice to have someone to bounce ideas off or think about things who is absolutely focused on this and who is very engaged with organizations like the PRI and Climate Action 100. It's really nice to have James as a resource. The other place where we engage with James is on voting. So, we have a saying on our team, be your own best analyst. So don't just look at what consensus is and stick that in your model or call the Morgan Stanley analysts and take their view and call it your own. You were hired for this job to be your own best analyst. So you need to do that. And we have that exact same ethos with respect to ESG. So when it comes to voting, we don't just look at what ISS says and do exactly the same thing. And so if there's ever a debate or something that comes up, we will go to James and say, this is what ISS says, this is what we think, what do you think? And he is helpful in terms of walking us through different rationale and making sure, at the end of the day, he says, whatever you vote, you need to be able to defend it. So I'll give you an example, that during COVID, there were some Indian AGMs, and the banks were going to raise capital, and you needed to vote on an amount of capital that could be raised. And I said, banking is a regulated industry. They have regulatory capital requirements. I'm not going to vote on a minimum or a maximum amount they can raise, because if I vote for that and they need to raise more, they'll be technically bankrupt. So how can I possibly vote? And he's like, that's fine. You can vote yes, you can vote no, but you need to be able to justify it. And I agree that your justification is fair. So having someone who has a background and expertise in this to bounce those sorts of things off is very helpful.
Wonderful. All right, next question that we have for you, Mary. Do you know if over the long term your ESG focus has added or detracted from performance?
To be totally honest, I don't know. I can point to, if I wanted to answer that question, I can point to certain instances, many certain instances actually, where we have screened out stocks that have subsequently blown up. And so on that day, you can say, Yes Bank in India is a good example. The thing went almost completely bankrupt. We owned none in this fund, but we owned none in the India fund where it was a major weight. And I think over a period of a few days, we made 80 basis points of alpha. So you can point to that and say, yes, that generated alpha. But to be totally frank, there are other times when, that day late last year where the vaccine news came out, and you had a massive rotation into value stocks. You had massive rotation into, highly polluting steel companies, and we don't own any of that. On that day, our ESG process would have led to negative alpha. So we don't have a process to even those all out over time. And that's why the measurement stuff that we do from Sustainalytics is so important, because I cannot put my heart on my hand and say this is going to lead to better alpha on 1 year, 2 year, 3 year, whatever. Over the long run, I strongly, strongly believe that if you are in good ESG companies, you'll have better financial outcomes. But in the short run, we can at least say we are confident, very confident, that the ESG risk in our portfolio is lower than in the benchmark.
Wonderful. We have a fantastic question that's come through. Forgive me, Mary, I'm going to read this verbatim. Sure. How do you manage democratic protests in Hong Kong in relation to company selection? Has there been consideration or impact on your process? Are there any companies that would have passed your filters prior to those starting, but now may have been excluded on an S or a G measure?
Okay. There are about 5 very interesting points in this one question, so I'll try to deal with them all, and thank you very much to the person who asked this. So the first thing I'll talk about is protests. I think that investors need to have a single standard for how they deal with civil unrest around the world. And what I'm seeing right now is that there is a significant double standard between how people are viewing civil unrest in different parts of the world. So, for example, we all saw a few weeks ago the civil unrest in America. The day after, the market hit an all-time high. Whereas I have heard feedback from people, I'm not investing in an Asia fund, even though at the time we had one stock in Hong Kong. Hong Kong Exchange, that was it. And people saying, I don't want to invest in an Asia fund because there's protests in Hong Kong. They were largely peaceful protests. And yet in America, you have people getting shot and people sitting in Nancy Pelosi's chair with their feet up on the desk and nobody cares. I'm ranting a little bit and I apologize. This is not where we wanted this question to go. But with respect to democratic issues in general, I think there needs to be a consistent standard. So we do look at macro ESG. And I started looking at it. It's certainly not as formalized as our stock ESG, but I started looking at it a few years ago when I was in the Philippines, and President Duterte at the time had gone on this, I don't even know what to call it. He was very anti-drug dealer, and he was doing some pretty bad stuff, which I won't mention on the call. But I started thinking, if we are ever investing in a country where the leader is doing this, and Human Rights Watch was all over the Philippines, like, would we screen out a whole country? And we don't have a process to screen out a whole country, but we do have a macro process, and within that process, there's a whole bunch of line items. I can send this to you later if you're interested, that have to do with the political process and civil arrest, etc. And if that sort of thing is going on, it's very similar to ESG. You get a score of 0, -1, or +1. All those will turn to -1s, and our allocation to that country will be either 0 or less than what it would be otherwise. So to the very first part of your question, we do have something in our macro process that addresses civil unrest, and I wish that a lot of people that invested in developed markets had that same thing. Okay, the second thing has to do more with companies that would have passed our filters prior and after. The protests in Hong Kong, I mean, they don't really have a micro implication. So, or the micro implication is not necessarily because of the protests. So some of the companies that were impacted by the protests were retailers, because there were people on the street, and there was tear gas on the street, and people just didn't want to go out and shop in shops. So if we had owned those sorts of companies, which we didn't, but if we had, we may have sold them, not because something had gone wrong with their ESG, but because they had no customers and their sales were going to go down. So that's sort of addressing the middle part of your question. But a related question has to do with what happened with Trump, because in the final days of the Trump administration, and even parts of the final year, he just banned whole companies. And so there's the CMCC list, which is Chinese companies that have ties to the Chinese military. He put an executive order banning them. And generally, we don't own those kind of companies because, as you remember from the screen outs, armaments and weapons are screened out. But Trump, with no justification at all, put on companies like Xiaomi. So Xiaomi is like the Apple of China. So, I mean, can you imagine if you banned Apple because people in the U.S. military have Apple phones? Like, it doesn't, I mean, we can debate it. But anyways, even in those stocks so the Xiaomi was the only one that we owned, but China Mobile would be one that sometimes meet our growth criteria. CNOOC would meet our ESG criteria, but there were some stocks which were not military stocks. They could have been part of our portfolio. Sanctions are now on those stocks, and we do screen them out. Because it's very, it's risky to be holding stocks that have sanctions on them, and B, because we have investors who are US-based investors, and that would be a big negative for them to hold those stocks. So to sort of answer your last question, if there are stocks where something that happens and changes, particularly if it's at a government level with sanctions or whatever, we would generally screen those out while they're on some sort of banned list. So I hope that answers your question.
Thanks, Mary. We've got another question. What are you benchmarking yourself against?
So our benchmark is MSCI Asia ex Japan. So that's the MSCI benchmark that includes all the major companies in our region. And so that's, for our performance, that is our benchmark. When for the Sustainalytics benchmarking, when I say we put all the stuff in, they cover most of the stocks in our benchmark. I think it's like about 96, 97% that they cover. And so we benchmark the ESG risk rating for our portfolio versus Sustainalytics ESG risk rating for all the companies that we don't own. And then that's what brings up those bar charts showing that we have a lower ESG risk than our benchmark.
Thanks, Mary. Just next question we have here. Do you engage with all companies you invest in, and how have you maintained that contact through COVID?
Yeah, that's a great question. So yes, we do engage with all the companies. We can't just, this looks good on paper, let's buy some. I've been doing this for 20 plus years, so most of the large cap companies I've met many times already, even with IPOs. So then we might not have a chance to meet management, but you can always participate in a call or generally get a call with management prior to IPOs. In terms of how we're dealing with that during COVID, so me and my team used to spend a third of the year on the ground, and all of us are either from Asia originally or have spent time on the ground in Asia. So it's a bit of an adjustment to not go there. And we're also big on kicking the tires. So you don't just go to Asia and go to some 5-star hotel and go to meetings all day and then go back to the airport and fly home. We generally like going to visit factories and meeting people on the ground, that kind of stuff. So COVID has been interesting because we haven't been able to travel anywhere. But the good thing about COVID is that everybody is in the same boat. If there was just an Australia problem and everybody else was still doing the same thing and we were stuck at home, that would be a problem. But because everybody is stuck, brokers in particular in Asia have done a great job of just moving everything online. So we actually found last year we tracked all our meeting and company engagement, and there was a time in the middle of last year it was like double what it was the year before. And Ashok, our boss, was saying, "What the heck? Are you guys so bored? You're just sitting at home working twice as hard?" And we said, "No, it's because if there's a conference in Singapore or a conference in Mumbai, typically one of us would go. But if there's a Zoom conference, then all four of us will go. So really, our company engagement has increased a lot. And now that everybody's so comfortable on Zoom, if we want one-on-one meetings with companies that aren't set up by a conference, you just, like in China, you just WeChat someone or like, the management speakers on my team will do that, and you just set up a Zoom. Or in India, India's very big users of LinkedIn. You just go to the IR person, you say, "Can I have a 15-minute Zoom to go over your financial results," or whatever. So it's actually become that engagement part, even though it's not face-to-face, the frequency has certainly become a lot easier during COVID.
Great. Mary, we've got a couple more questions for you. Which stocks do you consider your most controversial and why?
Okay, that is a great question. I don't consider any very controversial. So one of the things we do is we go to Sustainalytics, and if say we're looking at a stock, if it is rated severe, we generally just stop looking at it because we are busy people and there's lots of things to do. And if within a severe rating, you can look at controversies. So it's interesting that you use that exact word. If we find a stock and it's a severe rating, or if we find a stock that's a high ESG risk rating and it has lots of controversies, we generally stop looking at it. So I don't consider any really controversial. I think the ones that have gotten the most headlines right now are probably Alibaba. And I don't even think that's ESG, but it makes people concerned that the Chinese government has that much control over one stock. And the anti-IPO, there were so many debacles within that thing. Like, they should have never approved it for an IPO in the first place if there were regulatory concerns over their capital. The timing to put it over the U.S. election was a very, very bad decision in hindsight. So, Jack Ma's speech, calling the Chinese banks, it wasn't Ponzi's. I think it was a Ponzi scheme. So he, there were many mistakes there, but I think certainly in the last 6 months, that has been the most controversial stock for us for reasons that aren't fundamental. I guess that would be my answer to that question.
We've got a follow-up question to that. What has been your best engagement outcome, and what was the lead time in achieving that?
So I'll be totally frank, we are not a huge fund, and the average market cap of our portfolio is over 150 billion. Of our top 10, just eyeballing it, I'd say that's about 350 billion. So, if I call the TSMC IR person with a query, the chances of it getting changed overnight are not strong. And I guess the other thing to say is we're investing in good companies. So I know a lot of people have a very different view, and they want to invest in companies that have improving ESG. And I'm slightly sympathetic to that, but that's not the route that we've taken. We want companies that already have good ESG. So it's not like we generally have a long list of these are the things that are wrong with your company, and we're going to work with you over the next 3 years to fix it. If there's a long list of things that are wrong with these companies, we are not going to invest it in the first place. I think the area where we have had the most traction is on disclosure, and that's probably the most important area. So I'm happy to say that. So what we did maybe 2 years ago is as part of that. There's a complicated slide going back a few that shows the screening process where funds originally get a -1, 0, or 1. And we found that a lot of companies were getting screened out because they don't have a CSR report. And so we made a list of our entire portfolio and our focus list of companies that had CSR reports and companies that didn't. And then we sent them all a letter, an email and like a physical letter saying, just so you know, this is our ESG process. You're getting dinged right at the get-go, not because you're bad, but because we can't tell if you're good or bad. And so if you could improve your disclosure and put out a CSR report, that would be helpful. Since then, we have seen a market improvement. And in some cases, the company was like, oh, we do have one. It's only in Mandarin or it's only in Korean, but we have people can read those languages anyway. So here it is. And so then we said to them, well, listen, can you just publish it in English? Because Sustainalytics and Bloomberg don't pick up on that if you, in some, so I think disclosure, to answer the question, would be the area where we've had engagement that led to outcomes. And the change can be anything between, like literally during the same phone call, they say, actually, we do have one and here it is, I'm sending it to you right now. Or Reliance, which we've been talking to them for, a year plus about, and with CA 100, and we still haven't seen, much action there. So that's how I would answer that question.
Thanks, Mary. We've got a couple more questions to go. Next one I have for you, how do you generate your new idea?
Yeah, so if you go back to one of those slides that has that sort of waterfall chart on it, there's quite a few that have them. So what we do is in the top, see that hurdle chart, we put all 1,200 stocks in our benchmark through the top. And then they have to jump over the growth hurdle, and if they don't meet the growth, then they're out of the process. It's kind of like a runner in a race, and if they trip over one of those hurdles, then they're out. So what happens is that, with the exception of IPOs, which I'll talk about later, our new ideas pop out the bottom of this of this chart. So say you have a stock which wasn't growing fast before, but something has changed, and now it meets our growth criteria. It will jump over that first hurdle. Say you have a stock that's been really, really, really expensive, and so it won't have enough upside to get into our portfolio, but for some reason, maybe it was COVID, and it fell for 30% over 2 days for no reason at all. It will start having enough upside to make it into our portfolio. Industry structure, these things don't really change over time. Or say there was a stock, Tata Motors as an example, the management was terrible for many years, and over the last 12 months, they've really improved their game. It used to be a screen out, and now it's a screen in. So we run all the stocks through this portfolio, and we end up with a focus list of 100 different companies. And that focus list can change over time based on what's happening with growth and what's happening with upside and the other things that I mentioned. And then what we do is on Monday mornings, the team and I do all these sorts. So we look at our whole universe, what the stocks have done over the last 5 days, what have gone up, what have gone down, what are technically overbought, what are technically oversold. And then we look at our focus list, those 100, and we say, which of these, which meet all our criteria and they get a score that's high enough to get into the portfolio, which of these look interesting at any given time and that are not in the portfolio already. Likewise, we look at stocks that are in the portfolio and say they're getting a score of 3. I'm like, well, that's not very exciting. The analyst updates your model. If it's still getting a stock of 3, then it may go out. So that is how we come up with new ideas. We have designed a process that feeds us the new ideas rather than people just sitting around saying, so who's got any new ideas? So I hope that answers that question.
Got a final question here, Mary, just on research house ratings. So Is the fund rated by Lonsec, or will it be any time in the future? We certainly are rated by Lonsec. We have an investment grade rating, and we also have an approved rating from Zenith. We're due to get a updated research report out from Lonsec within the next coming months or so we can update participants on that. Just in the interest of time, Mary, we don't have any further questions, but I might give participants one final chance to ask any burning questions they have remaining. Whilst we wait for them to do that, any final comments, questions, why Asia now? Anything you'd like to leave our participants with?
First of all, thank you again for taking time out of your afternoon to discuss with me. We are rated by RIA, and that process, I'm very proud of that process because we are the only Asia or emerging markets fund in Australia that's rated by RIA. And I'm also proud that we didn't have to do that much work to get the, don't tell RIA I said that, but not that we didn't have to do much work. You have to do a lot of work to get it in a format that fits them, but we didn't have to change anything. So we didn't have to, we aren't ESG enough, or we're not responsible enough, or we're doing this wrong, or whatever. So that made me very proud. The fact that as soon as we got Sustainalytics, we popped it in and it said, your ESG is better than the benchmark. And as soon as we started filling out the RIA stuff, it was like our process is in place. So I guess that's what I'd like to leave you with. We are unique in Australia because we're the only Asia emerging markets that has that RIA rating.
Wonderful. Well, there's no further questions that have come through, so I thank all our participants for joining us this afternoon. If there is anything you need post-session, a copy of the recording will be sent out to everyone shortly, but please don't hesitate to contact a member of the Ellerston distribution team if there's anything further needed. Thanks again for joining, and I hope you have a nice rest of your afternoon.